Hello, before we start today's video, just a quick note that if you are interested in purchasing this indicator, just simply email us at daytradinggps@gmail.com to request a discount promo code. In return for you taking your time for watching this video today, you can email us and request a discount promo code that will give you a substantial discount on the purchase of the indicator. All of our indicators are sold on a one payment for lifetime access basis. Thank you. One more thing before we get started, you'll see in the description of the video there will be this section here, which is click on this link for descriptions links to the other videos mentioned in this preview on different topics about the SPX indicator. So this is a Google Drive link. I'll show you where it takes you to now. So when you click on that link for the Google Drive, this is where it takes you to, which as you'll see is a list of different topics and links to the videos on the specific topics. These topics go into more detail. We may reference some of these topics very briefly in today's video, but when we reference to go look at the video that provides more details, then you'll just simply click on this link and go to here, and then you'll be able to click on the link that you want to see a more detailed video on a certain topic. Thank you. Hello, in today's video we'll be taking a look at the Thursday, November 13th, 2025 trading session for the SPX CBOE index. We'll be utilizing the Day Trading GPS SPX Daily Key Levels indicator for our trade entries and managing our trades. Specifically, we'll be using the V2.0 version of the SPX Daily Key Levels indicator, which was just released a few weeks ago. Okay, so some of you may already be familiar with how this indicator works from seeing our other SPX trading session videos, but for those who are not familiar with it, I will briefly run through it. However, I will tell you that I am going to make this video shorter than we typically do our videos on, so in order for you to get a fuller sense of how this indicator works, I would invite you to look in the description of this video, look for the section that says other SPX trading session videos, and take a look at those videos, which are a lot longer, which will go into more details about how this indicator works than we will be going through in today's video. Okay, so this indicator works on the TradingView platform, and it works on two different symbols for SPX on TradingView. One symbol is the symbol that you see it on now, which is the SPX CBOE symbol. So in TradingView, you would go to symbol search, type in SPX, look for the SPX symbol that is under the CBOE exchange. That is the main SPX official index that everyone follows. This is the symbol that you would use the indicator on for trading SPX options, specifically SPX index options. The other symbol that this indicator works on is the SPX 500 8-cap, which I'll show you now. Okay, so this symbol is SPX 500. So in TradingView, you would type in SPX 500 on your symbol search, and then you would look for the SPX 500 symbol that is under the 8-cap exchange. There are several reasons why you may want to use it on this particular symbol. One of which is if you do normally trade SPX index options, you would want to open up a second chart with this particular symbol for the following reason. You can get the levels for CBOE SPX index 30 minutes early at 9 a.m. Eastern New York time by having it on this symbol. So as you see here, there are two tables, one of which is the SPX 500 table here, and one is the CBOE SPX table. So this additional table here are the CBOE SPX daily key levels for today's session. However, they come out at 9 a.m. So this is currently on a 15-minute chart. So at 9 a.m. at the opening of this candle here, These are the levels that would be for the SPX 500 A cap here and here. And then you have this additional table here, which is telling you what the CBOE SPX index daily key levels will be for this session when it opens at 9:30 a.m. Eastern Time. This way you can get a 30-minute jump on that session if you're trading SPX index options, and this will give you time to go through some planning and additional analysis. The other reasons why you may want to use it on the SPX 500 ACAP symbol is if you are trading SPX through a Forex broker, or if you are trading through a Forex-based trading challenge company like FTMO or Apex or the 5%ers, in which you paid those companies to take a trading challenge. There's probably 60 or 80 of these companies out there. And then you take a trading challenge in which you can make a certain amount of profit in a certain amount of time, and without violating either a daily loss limit or a total loss limit on your account. And then if you pass, then you can be offered a funded live trading account with those companies, in which you can use their funds for the risk capital, and then you trade and you have a profit split with them, which is generally somewhere between 85 to 95% going to you and the rest to them for putting up the risk capital. And if you're trading with one of those companies, they're typically Forex based, which means you need to trade SPX through a Forex CFD, which is what SPX 500 is on the ACAP exchange. So you would utilize the indicator on this symbol for that purpose. Now we'll go back to the other chart. Okay, so now we're back on the main chart for SPX CBOE. So this is the symbol that you would use it on for trading SPX index options. So this indicator is a day trading indicator only. It is not a swing trading indicator. All of the positions that you would be opening with SPX index options with this indicator using our daily key level strategy are going to be positions that you'll be opening and closing in the same session. So you will just be day trading these options, and with that in mind, you will either be using SPX 0DTE options as the vehicle to make your trades, or you can also use 1DTE options if you prefer those. The 1DTEs will cost more than the 0DTEs. We do have a video on this particular topic that is about the pros and cons of using 0DTE versus 1DTE, and that link is found if you go to the description of this video. As we showed in the preview, you will see a Google Drive link that is a link that will take you to a document that will have various videos on other specific topics concerning this indicator, and one of those topics is 1DTE versus 0DTE, and then there's other various topics there. So I would invite you to take a look at that video, and if you want more details on that particular subject, as we are not going to go into it in this particular video. Okay, so today we're going to show you two different trades. There wasn't enough room to put them all on one chart with the comment boxes we placed here. So we have two different screenshots. So we're going to show you this trade first, and then we're going to show you the second trade afterwards on a different screen. This first trade is off of the 9:30 a.m. opening candle. As you can see here, this candle closes below, it opens below and closes below the bull bear key price level. The bull bear key price level is the most important key level that this indicator gives you on a daily basis. So after analyzing overnight and pre-market action, as well as recent price action over the last week in the SPX, as well as current market dynamics and volatility, the indicator's various algorithms will come up with the bull bear key price level for the current session. What this level represents is the initial session bias for the session. So above this level is bullish and below this bull bear KPL is bearish. Keep in mind that this is the initial session bias, and the bias of the session can change, meaning the price could start out below the bull bear key price level and then cross and close above it, and then we'd be looking at a bullish scenario. So this is more for the initial session bias and then continuing session bias throughout the session depending on what is going on. Now with this particular indicator, you can take bullish or bearish trades off of any of the main key levels. The main key levels with this indicator are the bull bear key price level and also the main R levels above, R1, R2, R3, R4, R5, and R6, as seen in this table. And then the S levels below, S1, S2, S3, S4, S5, and S6, is seen in this table here. We don't have all 6 levels above and all 6 levels below shown on the chart here because at the beginning of a session, it is best to drill down to where you have the bull bear KPL and then up to R2 or R3 above and then down to S2 or S3 below, as the majority of sessions will be confined within that particular range. So if you have all 6 levels above and 6 levels below on your screen, it's going to look too compressed, and it's more important that you see the granularity between the levels, especially at the beginning of the session. At the beginning of the session, the bull bear key price level is going to be the important price level that will be in play at the 9:30 a.m. opening candle and in the opening moments of each session. That will be attributable to 95% or more of the 250 to 255 sessions per year that SPX has. Later on in the session, the other levels can come into play for either bullish or bearish trades. The other levels meaning the other main R levels or other main S levels as price action continues to play out. And we will see an example of that in the other trade that we'll be looking at today. These midpoint levels are considered your standard stop loss levels above and below each main level. So, for example, the midpoint above the bull bear KPL is the standard stop loss for a bearish trade taken from the bull bear KPL level. The first midpoint level below is the standard stop loss for a bullish trade taken from the bull bear KPL. The QL levels are your tight stop losses above and below each main level. So for example, on a bearish trade taken from the bull bear KPL, the QL above is your tight stop loss on a bearish trade taken from this level, and conversely, the QL below is your tight stop loss on a bullish trade taken from this level. These QL levels can be turned on above and below each of the main R and S levels as well as the bull bear KPL. However, on default startup, the default look of the indicator only has these two midpoint levels turned on and these two QL levels turned on because these are the most important at the beginning of the session. The other midpoint levels that you see turned on here were turned on by us after the session had started, and you can simply turn them on by enabling them in the user control panel. There is a video in that Google Drive link that I described earlier. One of the videos in that Google document that the Google Drive link will take you to of all the videos is a video on the user inputs in the user control panel and all of the different features and display customization features of this indicator. So if you'd like to see that, you can simply take a look at that video, which is about an hour long, and it will go through all the features of this indicator as well as all the different inputs in the user control panel. Okay, The midpoint levels also have additional purposes, one of which is for continuing gauging momentum when a trade has moved in your favor, especially when the trade has moved in your favor and has exceeded the minimum required move for either an exit or an adjustment to your stop loss. These other levels here represent either previous day values or pre-market values. So, for example, the PMH is the pre-market high, the PML is the pre-market low, the YDC is yesterday's daily close, the RTH session close, YDL is yesterday's daily low, the RTH session low, and YDC is the yesterday's daily close, and YDH is yesterday's daily high, the RTH session high. These levels are also very important levels for context of today's session. So for example, for there to be any real significant bullish movement, it's not only the price is not only going to have to go above the and start closing consecutive candles above the bull bear key price level, it is also going to have to start closing above the pre-market high. And conversely, for there to be a significant down session, not only is price going to have to start closing below the bull bear KPL level, but it's also going to have to start closing below the pre-market low. These levels can also be used as waypoints when a trade has moved in your favor past the minimum required level move in your favor, as additional waypoints for decision making for either closing out trades or for adjusting your stop loss. So they serve that purpose as well. Okay, so getting into the session here, the 9:30 a.m. opening candle is marked off here. That is this candle here. As you can see, we're on a 2-minute chart. The 2-minute chart is the recommended chart time frame for this particular daily key levels strategy of trading SPX index options. The range of chart time frames for this particular strategy that are recommended are between 1 minute and 5 minutes. The 2-minute chart has been found to be the most consistent and best time frame within the 1 minute to 5 minute range. However, if you prefer using a different chart time frame, such as 1 minute, 3 minute, or 5 minute, that's fine, as you may also be using other indicators that you like in conjunction with this indicator. But as you'll see if you watch more of our SPX trading session videos, that we always use the 2-minute chart time frame because we have found it to be the most consistently best performing chart time frame within the 1 minute to 5 minute range for this particular daily key levels strategy. Okay, so this is the 9:30 a.m. opening candle. It opens below the bull bear KPL. It stays contained below the bull bear KPL, and it also closes below the bull bear KPL. It also is within the acceptable range for a trade off of the bull bear KPL. What I mean by that is the acceptable range, meaning it is not out of range to where another level would instead be in play besides the bull bear KPL, and thus you would avoid this 9:30 a.m. opening candle trade if that was the case. Those sorts of rare exceptions happen perhaps 5 to 10 times a year out of the 250 to 255 sessions. We do have a video on 9:30 a.m. candle trades to avoid, how to recognize them, and it goes into further details about what is an acceptable range and what is outside the acceptable range. And there's also a PDF document which goes into further detail that accompanies that video. That video is also found in the set of videos through that Google Drive link that you'll see in the description of this video. So if you want to see more on that topic, including also seeing in addition to that video, the Google Drive PDF document on that topic, then I would invite you to look at that. We're not going to go into all those details today. Just simply know that this candle is within the range for taking a trade off of the bull bear key price level on this 9:30 a.m. candle. Now the 9:30 a.m. candle is an optional trade in the strategy. There's no rule or obligation under the strategy that you have to take the opening candle trade as part of the strategy. It is an optional part of the strategy, and if you were inclined to take the 9:30 a.m. opening candle trades in general as part of using the strategy, then you would take this as a bearish trade, as this is a bearish entry signal. Now what about option strikes and then your stop losses on this bearish trade? There are always 3 option strikes that you can consider for taking a bullish or bearish trade off of any of the main key levels. The main key levels again are the bull bear key price level or any of the main R or S levels, the R levels above or S levels below. The midpoint levels and QL levels are not used for taking trades from, so just bear that in mind, that when we talk about a main level, it's either the bull bear key price level or the main R1 through R6 or S1 through S6 levels. So on taking either a bullish or bearish trade from any one of those main key levels, there are always going to be 3 option strikes that you can consider under this daily key level strategy. One is going to be an at-the-money SPX option strike that is closest to the price of the level that you're taking the trade from. In this case, since we're taking the trade from the bull bear KPL level of 68.3307, that would be the 68.35 option. And since it is a bearish play, it would be the 68.35 put. Now, as far as out of the money options, you have up to 2 choices. The way that you figure that out is, what is the level that we're trading from, the bull bear KPL in this case? What is the direction we're trading? We're trading down since this is a bearish trade. So the first out of the money strike you can consider is based on the midpoint level below the level that you're trading. In this case, it's this level, mid BBKPLS1. 68.2443. The closest SPX strike to that is the 68.25 strike. So the 68.25 put in this particular case on this bearish trade taken from this level is your first out of the money strike you can consider. The final out of the money strike, or the furthest out of the money strike you can consider on a trade, is a out of the money strike that is 1 level away from in the direction that you're trading. So this is the level we're trading from. The direction we're trading is down. So 1 full level down is S1, 68.1578. So the 68.15 strike is the furthest out of the money strike you can consider on this trade. Now what about entry? You enter on the close of the candle. Why? Because we're waiting to see, to confirm direction and bias by the close of this candle. So as an example, this candle could have opened up below the bull bear key price level, but intra-bar traveled above the bull bear KPL and closed above it. In that case, then we would be looking at a bullish entry signal and a bullish trade off of this level instead of what we have here. Also, the most important aspect of the 9:30 a.m. opening candle is, where is it closing? Is it closing below or closing above? So for example, like I said, this could have opened down below here, crossed above and closed above, and that would be a bullish signal. It could have also opened above, crossed below, and then closed below. That would be a bearish signal. The main thing is, where is it closing? So if, for example, it opened above, it was the exact mirror image opposite of this. It opened above, stayed above, and closed above. That's a bullish entry signal, as long as it's within range. Also, you could also have a situation where it opens below, crosses into bar above, and then closes the candle below. that is a bearish entry signal, again, because it's closing below. And it can be the exact opposite. It could have traveled interbar, it could have opened up here, traveled below here, then went back up and closed. That is bullish. So just keep in mind that the most important aspect is where is it closing, as long as it's within the acceptable range. Okay, so what I've lined out here is both 0 DTE options on this trade and 1 DTE options. The 0 DT options, you have the 68.35 at the money, which is the standard play. So keep in mind the standard play is always going, with this strategy, is going to be the at the money strike. And you have the 2 out of the money strikes as optional plays if you prefer out of the money strikes due to cost concerns, or you prefer out of the monies for whatever reason. But just keep in mind there's only 2 out of the money strikes you can consider, and only 3 strikes you can consider in general on any bullish or bearish trade from any of the main levels. On the candle close of the 9:30 a.m. candle, this was 26.30. However, if you look at this note here, you also could have entered on the next candle, the 9:32 a.m. candle as well, as it is still closing below the bull bear KPL, and this candle is still within the acceptable range for this trade. So if you missed the 9:30 a.m. candle, or were just waiting for a different candle for additional confirmation, then you could have also entered on this trade, on this candle. And if you did enter on this candle, you would have gotten a little bit better price than on this candle. As we see here, the price on the 9:32 a.m. candle close was 22.80. So as you can see, that is about a 15% difference in price. Now what about the first out of the money strike? The 68.25 on the 9:30 a.m. candle close was 18.90, and the 9:32 a.m. candle close 18.30. The furthest out of the money strike was the 68.15. So for the 0 DTE, the 9:30 a.m. candle close $15, the 9:32 a.m. candle close $14.30. If you're not familiar with how options work, you multiply this number times 100, and that is the cost of one option. So for example, 1430 times 100, $1,430 would be the cost of buying this option on the close of the 9:32 a.m. candle. The 1 DTE options are a little bit more expensive. The 9:30 a.m. candle close on the at the money 68.35 is $34.50. The 9:32 a.m. candle close on the same strike $32.77. The 68.25 strike is $30 on the 9:30 a.m. candle close and $26.38 on the 9:32 a.m. candle close. The 9:30 a.m. candle close for the furthest out of the money 1 DTE 68.15 is $24.48, whereas the 9:32 a.m. candle close is $22.60. Now what about stop losses? Stop losses are based on levels. So your entry stop loss is based on levels. However, when the trade starts going in your favor, as we'll explain later on, once it's reached the minimum threshold for a regular trade, then you have the option of adjusting your stop loss to break even or better if you prefer that over just closing out your trade. At that time, then you're changing your stop loss from a level to instead being the price of the option. So for a bearish trade off the bull bear KPL, the standard stop loss is the midpoint above the level you're taking the trade from, which is this level here. The tight stop loss is the QL above the level you're taking the trade from, and since this is a bearish trade, it's the QL above. Now your stop loss is the same regardless of whether you're using at the money or out of the money strikes, because it is level based, not price based. Not price of the option based. There are a few brokers that allow you to Place stop losses on options based on the price of the underlying, meaning a price level of the underlying. One of those is Charles Schwab, which now owns the Thinkorswim platform. So if you use Thinkorswim, that feature is available on that platform, both on the mobile app as well as the desktop app. And they also have a feature that allows you to also take profits based on the price level of the underlying as well. Another broker that offers that is Interactive Brokers. Now, in that description, link that was in the description, one of those videos is on using the Thinkorswim platform to place stop losses on options based on price levels of the underlying. So I would invite you to also take a look at that video if that's of interest to you. You can ask your broker, if you don't use either one of those brokers, if they offer that for options that have stop losses based on the price of the underlying. And perhaps there are other brokers that do. If your broker does not, then you can either consider switching to Thinkorswim or Interactive Brokers. If you are not willing to do that and your broker does not offer that, then you will need to manually stop yourself out when and if price happens to hit either your tight stop loss or your standard stop loss. Or you can simply set an alert on the TradingView platform for when price touches either your tight stop loss level or your standard stop loss level. And you would do that by just using your standard TradingView alerts that are built into TradingView for a price touch or price cross, and then put in the level. So on the standard it would be 68.4172, or on the tight stop loss in this trade 68.3739, and then you'll get an alert when price touches or crosses those levels if it does, and then you would manually stop yourself out. Okay, so with this indicator there are two different types of trades that you can take. One is scalp only trade, the other is a regular trade. So on scalp only trades you're looking for a one level move in your favor, and then on scalp only trades there are no adjustments. On scalp only trades, utilizing this indicator and the daily key levels trading strategy, you have a 100% closeout only on scalp trades. So when it hits your one level move in your favor, you then close out all of your trades and take your profits. There's no adjustments. There's no adjustments to your stop loss. There's no scaling out, etc. So whether you're trading one contract, 3 contracts, 5 contracts, or 50 contracts, if you're just doing a scalp only trade, then you would close out 100% of your contracts on your scalp. And on the 9:34 a.m. candle, we have an S1 hit. S1 is one level below the level we're trading. So that is how you figure the one level move. You take the level that you're trading, the direction that you're trading, which in this case is down. One level down is S1. That is your scalp target. On the 9:34 a.m. candle, the S1 was hit. That's your scalp only one level minimum required move target. Here are the prices on the candle close. Now, we have a range here simply because we're looking at the entry of the 930 versus the 932. So the lesser price is going to be the more expensive entry on the 9:30 a.m. candle if you took that, versus the greater profit is on the 9:32 a.m. candle, in which those options costed less. The 68.35 0DTE was 28.49. So that's anywhere from $219. That's either $219 profit on the 9:30 a.m. candle if you took that entry, or $569 profit if you instead took the entry on the 9:32 a.m. candle. The 68.25 0DTE was 23.37 on the candle close on this S1 hit, and it's $447 profit up to $507 profit. The 68.15 0DTE was 18.30, so that is $330 up to $400 profit. The 68.35 1DTE put was $37.80, so that's $330 to $503 profit per option. The 68.25 1DTE was $32.70, so that's $270 to $632 profit per option. The 68.15 1DTE was $28.70, so that's $372 to $560 profit per option. Now in the 9:38 a.m. candle, it hits the mid S1, S2 level here. That is a regular trade. Once you have reached the minimum required 1.5 level move target for a regular trade, then you have these options. So how you figure 1.5 levels is the level we're trading from, this level here. One level down is here, that's the scalp. Then you have a half level. So this level is your 1.5 level move for the regular trade. So that triggers these options for you. Either 100% closeout of all your options, whether you're trading 1, 3, 5, 10, or 20 or more contracts, or adjust your stop loss on all contracts to break even, which is the price now that you paid for the option. Remember, we start out with a level-based stop loss. Now we're changing to a price-based stop loss, price of the option-based stop loss, because now it has hit our minimum regular trade target. Or break even plus a 10 to 15% initial profit buffer, which is what PB stands for. So in that case, you would add 10% on to the break-even price as your initial profit buffer, or up to 15%. Excuse me. Or if trading multiple contracts, you can close out 70 to 90% of them and adjust the stop loss on the remaining runners if you want to see if you can get further profit out of the move before it's still moving in your favor. So for example, this only applies if you're trading multiple contracts, such as 3 contracts, 4 contracts, 5 contracts, 10 contracts, 20, etc. So for example, if you're trading 4 contracts, you closed out 3 of them here for full profit when it hits this 1.5 levels, then that's 75%. 3 is 75% of 4. Or if you were trading 10 and you sold 8, that would be 80%. If you were trading 5 and you sold 4, that's 80%. If you're trading 10 and you sold 9, that would be 90%. Then you're adjusting your stop loss on the remaining runners to break even, or break even plus the profit buffer. Then at each succeeding level move in your favor after the minimum 1.5 level move, you have the same options decisions to make at each succeeding level in your favor. If you already adjusted the stop loss at the 1.50 minimum required level, then if you want to stay in the trade at each succeeding level move in your favor, instead of closing out anything that's remaining, then you would add additional profit buffer amount at each level move in your favor to your stop loss on any remaining contracts that you do not close out at each succeeding level move in your favor. So on this mid S1, S2 hit, the prices on the candle close, the 68.35 0DTE at the money, 34.13. That's $783 to $1,133 profit per option. The 68.25 was $26.80. That's $790 to $850 profit per option. The 68.15 0DTE was $21.30. That's $630 to $700 profit per option. The 68.35 1DTE was $41.90. So that is $740 to $913 profit per option. The 68.25 1DTE is $36.30. So that is $630 to $992 profit per option. The 68.15 1DTE was $30.83, so that's $635 to $823 profit per option. Now at 9:44, it hits the S2 level. That is now a 2-level move. 1 level, 1.5 levels, 2 levels. A 2-level move in our favor. This is known as the ideal 2-level move. Why is this called the minimum ideal level 2-level move? And this is the minimum required 1.5 level move. What we mean by ideal level move is that in the majority of sessions where you see low to moderate volatility, as being the case in the general market for sessions leading up to that, if we're in a low to normal volatility environment, a two-level move in which a low to normal volatility environment is what you're going to see about 80% of the time in a given year. So since that's the majority of the time, a two-level move is typically in your favor going to be the full extent of most moves in a low to normal volatility environment. In a higher volatility environment, you will see more moves in the 3 to 4 or 5 level move in your favor or above. So, with that in mind, it's called the ideal two-level move because you need to be cognizant that if you want to stay in the trade after the two-level move, you need to be more cognizant that if we're in a low to moderate or medium normal / normal volatility environment, that's going to be the extent of most moves. So if you are going to stay in a trade after the two-level move and not close out all of your contracts, you just need to be cognizant of that and be aware of that as far as any stop loss adjustments or any continuing management of the trade. However, on any given session, anything can happen, and as we saw today, it did continue to move down. However, as you see here, after the two-level move, it did make a sharp reversal move back up after hitting the two-level move in your favor at the S2 level. So if you did adjust your stop losses, if you had any remaining runners and did not close out all of your contracts here or here, so if you didn't close them out here or you didn't close them out here, and you had any remaining runners, then you would have definitely gotten stopped out on your break even because it did go back up and retrace the entire move all the way back up here. Okay, so on this two-level move, the prices on the candle close, the 68.35 0DTE put, 42.50, that's $1,620 to $1,970 profit per option. The 68.25 put, 35.20, that's $1,630 to $1,690 profit per option. The 68.15 0DTE was 28.11, that's $1,311 to $1,381 profit per option. As far as the 1DTEs, the 68.35 1DTE was 47.90, that's $1,340 to $1,513 profit per option. The 68.25 1DTE was $42, that's $1,200 to $1,562 profit per option. And the 68.15 furthest out of the money 1DTE was 36.32, that's $1,184 to $1,372 profit per option. Now we'll take a look at the next trade of the day. Okay, the next trade of the day is a bearish trade off of the S1 level. As you can see here, after the initial trade hit the S2 level, the ideal minimum two-level move, it had this retrace back up and actually challenged the open here and wicked slightly above the open. Then it began its descent back down again, and we have here a close below the S1 level. This is the 10:20 a.m. candle here, this is the 10:22 a.m. candle, and this is the 10:24 a.m. candle here. All three of these candles are within range for a bearish trade off of the S1 level. So we have the first cross and close below the S1, so this could be your initial trade entry. However, if you wanted additional confirmations, you had the additional confirmation here, and both of these are still within range for taking a bearish trade off of the S1 level. Now in the case of the S1 level, it's the same process that we went through in the trade that we showed you to begin with. This is the level we're taking the trade from. So the standard play is going to be the at the money strike closest to the level we're taking the trade from, and in this case that would be the 68.15 strike. This is a bearish play, so it would be the 68.15 put. Your first out of the money one you can consider on this bearish play from S1, you look to the midpoint level below S1, the level you're trading, mid S1, S2, 68.0713. the closest strike to 6807.13 is the 6805 put. And the furthest out of the money you can consider for a bearish trade from S1 is one level down, and that would be the S2, 67.9848. So the closest strike to this price is the 6800 put. Now, in this particular trade, we're only going to look at the 0DTE options. If you would like to look at the 1DTE options, then you just need to go to the broker that you use and look up these options at these different closes of candles on an option chart, on a 2-minute option chart for these particular candles as far as your entry prices, and then look at a 2-minute chart for these candles for all of the moves that were in our favor here on this trade. But for this, we're only going to look at the 0DTEs on this trade. Okay, so what about stop loss? It's basically the same process we used on the other trade, except we're taking a different level. We're trading from a different level. So on this S1 trade, this is a bearish trade. So the tight stop loss is going to be the QL above S1. S1 is where we're taking the trade from. Your tight stop loss is the QL above that level. Your standard stop loss is the first midpoint above that level. Now, as I said on the other trade, whether you're using the at the monies or out of the money strikes, it's the same stop loss because it's level based on your trade entry. Okay, so 0DTE options, standard play at the money put option, 68.15. Price on the 1020, where we're going to run through the prices for each one of these candles so you could see off of these different entries what the prices were. 1020 AM candle for this, 1437. 1022 candle, 1590. 1024 candle, 1560. On the out of the money 6805, the 1020 AM was 1044, the 1022 AM was 1160, and the 1024 AM was 1110. The furthest out of the money 6800, on the 1020 AM candle 910, 1022 AM candle 1010, and the 1024 AM candle 944. Now, as you can see here on 1034 AM, right here, so I forgot to draw an arrow for here, so my apologies for that. But on this candle here, this is the 1034 AM candle, it hits S2. That is your one level minimum required move for a scalp trade. Remember, scalp trades are 100% closeouts only. Here are the prices on the candle close. Now, the profits range from the highest entry price to the lowest. So the highest entry price out of these three down to the lowest. So the greatest profit will be from the lowest price paid out of these three, as the least profit will be the highest amount paid out of these three. So that's what constitutes this range that you'll see in all these. The 68.15 put was 25.45 on the scalp candle close, $955 to $1,108 profit per option. The 68.05 was 19.34. That's $774 to $890 profit per option. The 6800 was 16.90. That's $680 to $780 profit per option. Here on the 10:46 a.m. candle, it hits mid S2, S3. Now that is a 1.5 level move in our trade. So again, S1 to S2 is one level. Down to the midpoint below that, that's 1.5 levels. 1.5 levels from the level we're trading in the direction we're trading. The 68.15 was 38.60. That's $2,270 to $2,423 profit. The 68.05 was 30.30. That's $1,870 to $1,986 profit per option. The 6800 was $27. That's $1,690 to $1,790 profit per option. Here on the 11:40 a.m. candle, it hits S3. Now we have a minimum ideal two-level move in our favor from S1 to S3. Prices on the candle close, 68.15 0DTE, $50.49. That's a $3,459 to $3,612 profit per option. The 68.05, 44.69. That's $3,309 to $3,425 profit per option. The 6800 was 40.21, so that's $3,011 to $3,111 profit per option. Now here on the 126 candle, this candle here, the candle before it did not quite make it down, but this candle here touched it and then bounced off of it a little bit and closed slightly above it. The prices on this candle close of the 126 candle is $66.91, so that's $5,101 to $5,254 profit per option. The 68.05 was $60, so that's $4,840 to $4,956 profit per option. The 6800 is $53, so that's $4,290 to $4,390 profit per option. And that is now a 2.5 level move in our trade. Move in our favor on this regular trade. 1 level, 1.5 levels, 2 levels, 2.5 levels. Finally, here at 1:26 p.m., it hits S4. That is now a 3-level move in your favor on this regular trade. S1 to S2 is 1 level, to this level 1.5, 2, 2.5, 3. Price on the candle close, 68.15, $86.83. That's a profit of $7,093 to $7,246 profit per option. Remember, the 68.15 is the standard play. 68.05 was $80.26. That's $6,866 to $6,982 profit per option. Whereas the furthest out of the money, 6800 put $70.51, $6,041 to $6,141 profit per option. Okay, so that's going to wrap it up for today's video. If you like this video, please hit the like button as it helps us with the YouTube algorithm, so we do appreciate that. If you'd like to subscribe to our YouTube channel, hit the subscribe button and you'll be notified when we post new SPX session videos or session videos on our other indicators that are for stocks, ETFs, Forex, and crypto and futures. Also, we do post videos on other trade topics periodically, so if you'd like to be notified of those as well, then if you subscribe, you'll also be notified of those as well. Also, remember to take a look at that Google Drive link in the description of this video. And also, if you'd like to see other SPX session videos in which we go into a little bit more detail than we did today on how the indicator works, you can also see a link to those videos in the description of this video. If you would like to purchase this indicator, all of our indicators are sold on a one payment for lifetime access basis, which means you make one payment, then you have access to it for life. That includes any updates or any additional versions that have additional features that are coming out in the future are also included in your lifetime access. But if you will send us an email to daytradinggps@gmail.com, you can request that we send you a discount promo code to purchase this indicator, and in return for you taking your time to watch this video today, we will send you a discount promo code that will give you a substantial discount off of the purchase price of this indicator. The link of which is found in the pinned comment to this video. Okay, so thank you again for taking the time to watch this video and for supporting our YouTube channel, and we wish you much prosperity in all your future trading. Thank you.